Hello, good day and welcome to the seminar on application of algorithmic trading. This is an introductory seminar to understand algorithmic trading better. It's designed to educate investors, traders, brokers, professionals and students in the technology-centric world of algo trading. Whether we like it or not, algorithmic trading is here to stay, and it's likely to have a massive impact on the way we invest. And I suspect that by the end of this three-part seminar, you will end up a fan of algorithmic trading. Let us begin. The first thing we need to understand is that algo trading is a software-driven process. Hence, it's somewhat hard to visualize and relate to. The seminar will pick up on real-world examples that correlate to algorithmic trading and explain it to you in a known context so you understand it better. Part 1 of this seminar, which is this part, deals with addressing the common myths and misunderstandings surrounding algo trading. Here, we will draw parallels to travel options such as traveling by train and traveling by planes, to trading options such as trading manually and trading using algorithms. Part 2 of this seminar deals with developing a better understanding of algorithmic trading as a process. Here we will draw parallels to the modern computer and its evolution into the product it is today. This will let us understand the process of algorithmic trading and how it is likely to evolve into a large product tomorrow. Part 3 of the seminar discusses the process of bringing algorithmic trading to the market. Here we will draw a very interesting parallel to batting in international cricket. Let's begin with dispelling your myths about algo trading. The most common myths surrounding algo trading are the following. The first is algorithms cause flash crashes. Flash crashes are usually a very fast, a very quick crash in a certain security or a set of securities or a benchmark index in the markets. This crash is almost always followed up by a return to the earlier levels or to comparable levels from where the market actually crashed. This is usually attributed to algorithms but is often caused by manual trading as well. As all human systems, algorithms can fail and can have some errors. Algos are based on rules. It's a rule-based system. If adequate rules are not put in place to constrain an algo, yes, the algorithm may cause flash crashes, but that does not mean that the algorithm itself is responsible. It's the person programming this algorithm not putting adequate controls in place to monitor and stop this algorithm that causes flash crashes. But flash crashes are also caused by manual trading. Now the second myth that we address is algorithmic trading is the same as high frequency trading. This is not true. High frequency trading is a subset of algorithmic trading. It is a type of algorithmic trading which is used to exploit trading opportunities that cannot be exploited by humans. These opportunities exist for fractions of a second and no human can react quickly enough to take advantage of these opportunities. This is what high frequency trading is, and not all algorithmic trading is high frequency trading. The third and most common myth is that algorithms require some expensive infrastructure and rocket scientists. It is true that algos do require some additional expenditure on infrastructure and human resources. But today, we are moving in using better technology for everything. And in our technology-centric world, the cost and the expense associated with algorithmic trading systems is quite affordable when compared to the benefits provided by these systems. Now let's discuss some of these myths in a little more detail. This is a plane crash. This plane crash is a representation of the fact that human systems can malfunction, that human systems are not foolproof, human systems have errors, And most definitely these systems can crash. We have all heard of or witnessed plane crashes. But does that mean that we stop using planes? Not really. In case of a plane crash, what we do is we determine what the cause or the causes of this crash were, and then we put robust mechanisms in place to prevent such a crash from occurring in the future. Now, I would like to take this thought forward to algorithms. In recent times, we have seen what we like to call flash crashes in the market. But almost always after a flash crash in the market recovers from these incidents. As you can see in this chart, this was the May 6th crash in the United States. The market crashed but almost immediately recovered from this crash. And the recovery is just as fast as the crash was. Yet nobody seems to call this a flash recovery. We only look at the downside. Nobody is looking at the upside of what happened here. Similarly, when it comes to a plane crash, when someone is part of a plane crash or someone really close to you is part of a plane crash, you feel that it's the end of the world. The same thing happens to the participants of a market when the market crashes. You feel that it's the end of the world. But that's not true. The market goes on. It comes back to normal, it recovers, and it goes on. So the question that is algorithmic trading the end of the world? Well, the answer to this question is not at all. It's here to stay, and it's likely to give us many more advantages, just like traveling by planes has given us many advantages. Taking this example forward, I would like to compare and draw a parallel to the different travel options available to us. When someone wants to travel, just not travel often, but someone who hardly travels and needs to travel, he'd usually travel by train. This is for travelers who don't have too many travel commitments, don't travel frequently. Trains are a very sensible and an efficient option of traveling for these people. Similarly, in the markets, we have manual trading. When one doesn't trade too much and makes very few transaction commitments, it's quite efficient and quite sensible for them to trade manually or to have a broker trade on their behalf manually. But now consider that you are an enterprising business person and you travel quite often for your business. Your business requires that you be in different places relatively soon. You will definitely require a more efficient way to travel. Air travel will become an invaluable resource in this case. If you travel by train, you will likely miss out on many of your business opportunities and many different networking opportunities. This is not affordable for an affluent businessman. Hence, he travels by air. Similarly, if you're an active investor or an active trader, you need resources that keep you up to speed and in touch with the markets. If you have algorithmic trading, you will constantly be in touch with markets. If you do not have algorithmic trading, you will miss out. If you trade manually, you will miss out on many trading opportunities available to you. This is not affordable for an active trader because each opportunity has an associated risk and profit. So taking this example forward, let's draw some of the parallels and see how these options evolve. So as we discussed, frequent travelers need planes to travel. Similarly, frequent traders need algos to trade. Now the next point that I want to make is that air travel opened traveling up to a whole new audience. Earlier, you would travel only if you needed to. Now people travel for leisure. People take vacations to the United States, which is, across the 7 seas. And they can do that within a day because you have air travel. A whole new tourism market has been opened up because of air travel. Similarly, new audiences are being attracted to algorithmic trading. Our country has a lot of systems thinkers. We're the IT hub. We have a lot of engineers. And engineers love to model. Algorithmic trading presents the stock market as a model. versus an erratic situation which most people associate our stock market to. When the stock market is presented as a model, a lot more people want to try and adopt this model and trade on this model. Hence, algo trading is likely to attract a lot of people to it. The third example applies to the people who provide these services. So in travel, you have travel agents. Travel agents can't survive if they don't provide you an air travel option. If your travel agent tells you, I'm only doing rail booking, train bookings for you, I'm sorry, I don't do any air travel bookings or air travel options for you, you're probably going to dump your travel agent and find another one who gives you air travel options. The same thing applies to stockbrokers. If a stockbroker is to survive, he needs to offer algo trading. He can't say, I just give you manual trading. And if your stockbroker is currently not providing you with algo trading options, you probably want to dump him for someone else who is providing you with algorithmic trading options. The last parallel that I want to draw, one which we've already drawn, is that these are all human systems, and there are errors in human systems. Errors cause planes to crash, and errors also cause trains to crash. This doesn't mean that we stop using planes or trains. Similarly, algo errors can cause crashes, but manual trading errors also cause crashes. In fact, one of the most recent crashes on October 6th in the benchmark index of the NSE, the Nifty, there was a 15% crash on October 6th, which was caused by a manual trading error. This was not an algo error. In fact, had algorithms been present in that system, this error would never have occurred because it was an unusually large order that hit the market. Hence, algorithms would have saved us in this case. So that's what I have. I hope I've dispelled some of your myths and encouraged you to try and understand algorithmic trading better as an option for you. Thank you for listening in, and please do tune in to the next edition, part 2 of the seminar on algo trading. Goodbye.